all day, but we have to get this party started. Again, good afternoon, and welcome to the very first ACUMA Fast Track webinar of this year. My name is Peter Benjamin, and it's my honor to host today's session. We have one of my favorite experts here, and he'll impart some valuable words of wisdom and share with us the most needed things that we have to pay attention to for top compliance topics in 2024. Now, before we dive in, just a few housekeeping items from ACUMA. This session is being recorded and will be posted to our website at a later date. I will be monitoring the Q&A. Feel free to ask questions and I'll do my best to weave them into our session. Now, this year has already started off at a rapid clip. Our first event of 2024 is being held in really just a short week and a half from now in beautiful Phoenix, Arizona. Not only that, registration for our workshops was officially opened earlier this month. Our May workshop is being held in Nashville, Tennessee, and June's will be in Denver, Colorado. We truly hope to see you at one of our upcoming events. Now, and finally, a quick disclaimer. The views and opinions expressed during this webinar do not necessarily reflect the views or positions of ACUMA, its board of directors, its management staff, or its members. The webinar and its materials are presented as a set of ideas and possible strategies regarding its specific topics and do not represent any endorsements of either the presenters, their firms, or the concepts they present. Okay. I think that's all for now. So today's webinar is being brought to you by ACES Quality Management. Joining us from ACES is Mandy Phillips, Executive Vice President of Compliance. Mandy, welcome. Thanks for being here. It's really good to see you.
Thanks for having me. I always love joining the ACUMA crew. It's one of my treats of the year.
I love it. I love it. Now, Mandy, for me, and I'm sure for a lot of people on today's webinar, I consider you to be one of the brightest minds in our industry. And so if it's okay, I'd like to pick your brain and get your thoughts on a few things. Is that okay?
Absolutely.
Wonderful. Love it. Love it. Now, as I mentioned, today's really focused on compliance. And you being the Executive Vice President of Compliance with ACES, I think it's this first question is really suited perfectly for you. Now, I don't want to steal anyone's thunder, but what are, in your opinion, what are some of the big ongoing concerns for credit unions this year or next from a compliance perspective? What are some of those big concerns?
Oh gosh, the $1 million question, right?
That's why you get paid the big bucks.
There is no shortage of things that credit unions are worried about from a compliance perspective. Actually, Michael's going to touch on a bunch of them today that he and I agree on. He and I align on a lot of things. Actually, most things. We're good friends.
Most things.
In this rising rate environment, there's been a rise in ARM products again. So making sure that we understand our ARM products and required disclosures around those. Appraisal bias is still a huge hot topic. And at the top of the list around that topic is reconsiderations of value, or ROVs. And of course, we're getting into the springtime of the year, and we've all heard a ton about property taxes rising and hazard insurance going up. So really, escrow statements is going to be a big thing, which I'm sure for anybody that's portfolioing, they'll have a lot of customer service calls coming in related to those statements coming around this year. So being prepared for that. That's just a couple things. I mean, seasoned QM, Michael's going to touch on a bunch of this. This is going to be a great day.
It most certainly is. Yeah, I've been looking forward to this one since we kind of started framing this up in really late November. We started thinking through what would be an excellent topic to discuss as our first Fast Track webinar of the year, and really looking forward to this. Now, sticking with you, and of course, the things that you're focused on, obviously ACES Quality Management, QC, correct me if I'm wrong, but QC or quality becomes pretty important in this type of market. And I'm guessing you agree with that. Now, Does strong quality control give credit unions more business options, just from your perspective?
Yeah, absolutely. So if we think about a lower volume market, right? If we have quality issues on just a few loans, it becomes a larger proportion of our origination or portfolio than it was in a high volume market. So any loan with a problem becomes a bigger risk just because there are less loans being produced. And so if you have a strong quality control program and can control your quality of the loans that you're producing, it really does provide you with less risk and therefore more opportunity to originate more loans, selling into the secondary market for those that do. You want high quality loans to be able to do that, right? And so having that really strong quality control department is essential as a line of defense, especially in a low volume market.
Right. And yeah, I mean this in the best way possible. I do. Like what we do as an industry, in many ways, it's part blessing, part curse. It's a blessing because we get to put families in homes, right?
Yeah,
It's a curse because we are probably I would easily consider us to be one of the most heavily regulated sides of the financial industry out there, right?
definitely.
So to that point, knowing that how heavily regulated we are, right? And there's a lot of things that we have to focus on from a compliance standpoint. How can credit unions prepare, even adapt to everything that's happening currently? And you can read any policy update coming out of Washington and see that we have things that we focus on now, but there are things that are coming down the line as well. So what can we do now to start adapting to all the regulatory requirements?
I would say have strong partnerships, particularly with your vendors. Credit unions are in a unique position. They're not most of our credit unions aren't giant institutions with these huge departments that can sit and monitor every law coming down the pike and read every single page, the day it comes out. It's just too hard. And so having strong vendor partners like ACEs can help you keep up with those changes and regulations that are coming out. I mean, obviously being ACUMA members and attending webinars like this is also a huge plus.
Yep.
But vendors like ACEs, we have our compliance news hub that's available online. We have a compliance calendar that we publish on our website. And with strong vendor partners like ACEs, that can really sort of augment and supplement your monitoring program and provide you some really strong partnerships to do that.
That's great. That's great. So, it's, ACEs and focusing on that, how can quality control and really, how can that ACEs platform, a strong compliance and quality control platform, really help with the audits? And then I guess that would be the next step in that process. How
Yeah.
can that help with those audits?
Yeah, so a system like ACEs has amazing reporting tools and trending reporting tools that will not only help our credit union partners monitor their own compliance and create remediation plans and update their policies and procedures where they find holes and maybe just ways to tighten things up. But also when you have an audit request coming in from a regulator, you have those reports and documentation at your fingertips to provide to regulators, which really helps move things along and sort of put your best foot forward, right? When an auditor shows up at your door and you can say, look, I have this amazing system. I have these reports here. Have a peek.
Thinking back to my time, at my last credit union, a lot of things I did was on a spreadsheet, right? Our internal QC process was a spreadsheet, and the stacks and stacks of printed paper that we had to provide them, that was just a whole bunch of gobbledygook, was tough. Now, I imagine a platform like ACEs makes that transition pretty easy, right?
It really does. Man, spreadsheets. I have vivid memories in my past lender life when we still did everything. It was like email and spreadsheets. Let's get Microsoft Excel out. Here we go.
Yeah, you printed it off and it was like 10 pages long. It's like
tape it all together, right?
Exactly.
Oh my gosh, it's so true. Gosh, the memories. No, implementations with ACEs can take as little as 30 to 60 days. So you can, as a starting place, current spreadsheets can be imported into ACEs. We have former QC execs that actually run our implementation projects that make it easy. And really they hold your hand all the way through the implementation process, excuse me. So, if anybody's interested, of course, reach out. acesquality.com, check it out, and we would be glad to chat.
Fantastic. Well, Mandy, that's all the time we have for today.
Well, thank you.
Thank you. I truly appreciate your time today. And thank you to ACES Quality Management for sponsoring today's session.
Our pleasure. Thanks so much.
All right, we'll see you soon. As I mentioned, today's session focuses on the must-know compliance topics for 2024. Today's speaker, is really a bona fide expert in all things compliance. It's my pleasure to welcome Michael Christians, Regulatory Compliance Counsel with Michael Christians Consulting, LLC. Michael, my friend, welcome.
Peter, as always, great to be with you. Although I will say this, I'm a little disappointed that you cut off Christopher Cross. So,
I told you, I could listen to that all day. I'm not joking around. I love Yacht Rock. So when you said, hey, let's play Yacht Rock as my intro stuff, I was like, this is why we're friends. This is
well, and like I told the crew backstage, I said, look, no matter how badly I screw this up, you're going to get good reviews because the music, right?
So I told you, and just I'm gonna highlight that. I'm gonna point this out one more time. I am monitoring the Q&A. Feel free to chime in whenever you need to and ask a question to Michael, and I'll weave it into the conversation. But I'm not joking around. They're anonymous, but someone did say that they like the music.
Well,
so
they have good
we already
taste.
made one person happy.
Perfect.
All right, perfect. All right, so let's dive in. All right, so Michael, it's going to be an interesting year. In many ways, it kind of sort of feels like we're stuck in the matrix, or perhaps someone, I don't know who, invented the flux capacitor, transported us back to 2022. Several of the topics that we're going to discuss today are really right out of 2022's compliance playbook.
Yep.
You agree with that, right?
I do, 100%. Yep.
Like it's almost like we dusted them, like we ignored them in 2023, and we decided to dust them off and really focus on them again in 2024, right?
Yep.
Now, I know we have a lot to chat about, right? And Mandy kind of hinted at several of them, but I want to break them down with you.
Okay.
So if it's okay, we're going to do this slightly different than what we've done in years past. For this session, I've come prepared with my list, and I think my list, your list, and Mandy's list really kind of sort of all align, which I think is a fantastic thing that the three of us are on the same page. So first things first, and for our attendees, we're first going to establish the list of topics. Okay. We're then going to start from the top and walk through each topic one by one, and allow you to provide your insights into each of the topics. Now, a lot of this is I guess I'll preface this by saying, all of these topics have been brought up in some sort of policy. When I mean policy review, it's been based off of regulatory or legislative updates or some form of examination priority, right? Yep. So let's dive in to my topics, and we'll start from the top. Okay. Here's my list of topics I want to discuss with you today. The current regulatory environment. Let's set the stage. Okay, let's start off with the current regulatory environment.
Okay.
Let's move on to ATR-QM. I know it's been around a while, but let's still bring it up. Mandy mentioned this, disclosing of arms.
Yeah, that's a big one.
Let's focus on fair lending. Now, fair lending, if you listen to the NCUA, if you pay attention to what's happening on the Hill, fair lending is going to be a big topic this year and really going forward. I have two subcategories of fair lending: appraisal bias, which Mandy mentioned, but I also want to dive into AI a little bit.
Sure.
Yeah. And if there's time, which I'm hoping there is, I want to touch on RESPA Section 8. Sound good?
Sounds good to me.
All right, perfect. So let's start from the top. The current regulatory environment. Please provide us a high-level overview of it.
So I'm going to be the bad guy here, and I'm going to borrow a statement from the American Bankers Association, but I think it's an accurate one. It is a regulatory tsunami. Okay, we're drinking from a fire hose. if you will. We have a CFPB leadership that is so hyperactive, not only in rulemaking, but probably more so in guidance, circulars, enforcement.
Mhm.
Couple that with, guess what? It's an election year. Things could potentially change. So 2024, they're just going to be that much more active to try and get as much out as possible before there's potentially a change in leadership at the agency, right?
Right. That's right. That's right. Because at this, at least during the Trump administration, the director of the CPB serves at the will of the president. So
Yep.
it's very well possible that Chopra could be out at really at end of this year, right?
Yeah, absolutely.
Quite possible. Okay. Which means what we currently see with regulation by enforcement, which is kind of what they went back to, could completely pivot to what we saw, at least with Kraninger towards the end or during her time, before Chopra took over, was kind of sort of regulation by guidance, right? A little bit of that.
Yeah.
So,
Well, I mean, just think back to, I think you're exactly right, Peter. Think back to when Richard Cordray was in charge.
Mhm.
Then we transitioned to, before Kathy, it was, the guy who was in charge of the Office of Management Budget. But anyways, there was a significant swing.
Mhm.
We went to a much more muted CFPB, and now we're at the opposite. We're at the opposite end of the spectrum. So,
well, it's interesting, right? And not to get political, but at least during that times towards the end, before the transition to the to Chopra and the current current state of CFPB, from a industry standpoint, we were starting to see some changes in a positive direction.
Yep.
During that time, again, not political, which is just facts, right?
Yeah,
Revisions to LO comp is a good example, right? Revisions to ATRQM is another good example, right? So
very good. Yeah.
all things that we have discussed in the past, we're not talking about LO comp today, not at all, but we are going to talk about ATRQM. So,
Yeah.
Anything else on the current regulatory environment?
Buckle up. It's going to be a wild 10 months. We'll leave it at that. How's that?
Just buckle up. All right. So let's go on. ATRQM. So you and I agree that ATRQM is one of those topics that's going to resurface, right? I want to get your thoughts on this.
Okay. So here's what I'll say about, I think you made a very good point just a minute ago. ATRQM has been around for a while, and we saw some very positive developments with ATRQM when we got rid of this arbitrary 43% debt to income ratio, and we replaced it with the pricing test, comparing the APR to the APOR. I think that was positive for the industry as a whole. If you remember back to when that change occurred, another thing that came out of the CFPB at that time, positive, was this concept of seasoned qualified mortgages.
Yep.
And we haven't talked much about it recently because there was no reason to. We're just now hitting the time period where institutions can start taking advantage of this. So remember, seasoned QM, so long as certain requirements were met at the time of origination, first lien, fixed rate, points and fees, didn't exceed the cap, credit union did a full underwrite, even if it wasn't QM then. You go through a seasoning period, which is 3 years from the date that the first payment was due. And during that seasoning period, so long as the member had no more than 2 30-day delinquencies and no 60-day or more delinquencies, Now all of a sudden you just capture automatically QM status. So it's worthwhile to take a look at your outside the box, if you will, originations from 3 years ago that maybe for whatever reason you couldn't get across the finish line for QM status at that point, and see if you can now. There's a benefit to it.
So let me ask you a question, right?
Sure.
And before I do that, have I ever told you my seasoning joke, my seasoning dad joke?
Oh boy. Talk about buckle up. When you start telling jokes, I tell you what.
Come on, man. It's not that. It's a good one. It's a good one.
Okay.
Like
All right.
I used to love when people ask me, "Do we have any seasoning requirements?" Or I used to say, "No, we lend in every season." I used to love that. One of my favorite dad jokes in the mortgage industry. Anyways,
Yeah.
All right. So coming back, what it was good. It was good. You have to
It
admit.
was good. It wasn't bad. It wasn't bad.
Thank you. I'll take that.
Yeah.
All right. So I'm a visual person, so I have to kind of sort of imagine it, right? So for me, 3 years ago, I originate a 30-year fix, right?
Yep.
Didn't quite fit into the box, right? But I still originated because it was right for the member.
Yep.
Right. Let's say it was possibly asset depletion, something like that, right? Just something that was off, possibly didn't quite fit into the Fannie or Freddie guidelines, right? In theory, based off the season requirement, pricing aside, right? Interest rates aside, in theory, this loan now could be eligible for sale to Fannie Freddie. In theory,
Yeah.
In theory, okay.
Yeah. And here's, I think what the season qualified mortgage rule recognizes is that this arbitrary 43% debt to income ratio cap was just that. It was arbitrary. There are thousands, if not millions, of good loans to be made to a borrower who maybe has a 50, 55% debt to income ratio because they're sitting on a pile of assets, right? And so what this recognizes is they've now proven that. For the past 3 years, they've shown that even at a 52% DTI, they're still able to keep up with the payments. So why not grant those loans QM status now?
Well, not only that, thinking back to, that we'll say, prior to the safe harbor, or not so much safe harbor, that seasoning requirement, there was, the DU LP, automated underwriting safe harbor attached to that. Whereas if those underwriting systems provided you with an approved eligible, you automatically had safe harbor from ATRQM, right? And could sell those loans to the GSEs, right? So there was already a history proving that, hey, these loans aren't bad just because it's 47, 50% DTI. Although I almost never saw a DTI approved above 49, but 49% is still higher than 43. So, case in point. Well, I mean, I remember what ATRQM was, 2013 off the top of my head?
I think that's right. 2013. Yeah.
2013. I mean, just the pushback in everything that happened with implementation on ATRQM in 2013, all the system updates and all the guideline updates and the pushback and trying to figure out why the heck did they pick 43%, right? Like you said, an arbitrary number that makes no sense because that number does not historically or show that there was any rationale behind why they selected it. Right. So
why wasn't it residual income instead of DTI or something like that? Right.
Exactly. So anything else on ATRQM, because I had the same thoughts. I remember it clearly, but seasoning required, that now seasoning is up. So anything else on ATRQM?
Just one quick hit here.
Yeah.
What I find interesting, the other thing to remember, which again, I think is beneficial when we got rid of the 43%, the other thing we also got rid of was Appendix Q. Okay. So credit unions have a lot more latitude now as far as how you go about underwriting.
Well, it's
But
the documentation and with the acceptable documentation or how you prove
exactly.
the
That's
borrower's
exactly right.
ability to repay, right?
Yep, exactly
So
right. Yep.
now, do you foresee, and I know you don't have a crystal ball, and I know that here, here we are, February 2024, we're finally starting to see, the 3-year seasoning. We're finally starting to see, I don't say the benefits of the revisions, but the benefits of the revisions, 2021 revisions. Crystal ball, do you see any additional revisions coming out of ATRQM, or is this kind of a done deal? You think it's in a good place?
I think it'd probably be pretty far down on the CFPB's list, just because there seem to be other areas that maybe require more focus.
Right.
I think the industry has kind of accepted where we're at, and so I think everybody's just kind of okay with it to move forward as is.
Time will tell, right? I mean,
Yeah, sure.
I agree with you. I mean, just all the policy publications that I read on a daily basis, no one's even talking about ATRQM. But here we are, the first year that the 3-year seasoning comes into play, right? It could be. I don't want to speak negative about anyone, but it could be a matter of time before if these loans that are automatically 3-year season AQM, if something happens with them, then I could possibly see them revisiting it, right?
Sure.
But we'll see.
Yep.
But
Exactly.
it could also be based off the current economic environment, et cetera, et cetera, et cetera. So, okay, good. So
Okay.
we're good on ATRQM.
Okay.
Now, disclosing of arms.
Oh boy. Yeah.
I'm interested in this because
Yeah.
I was asked a question the other day. And I think you've been asked a lot of questions because you actually see it. It's how do you disclose arms, right? The issues attached with disclosing arms. 30-year fixes aren't really that attractive anymore. They haven't really been in the past couple of years, we'll say 2 years. So, in your opinion, why is disclosing of arms? And Mandy brought it up. Why is disclosing of arms such a big deal for 2024?
Personally, I think what has bubbled this to the surface is that we've been in a rate environment for such an extended period of time that no one was doing arm loans. Why, when you can do a 30-year fixed at 3 1/8, why are you even having a conversation about an arm loan, right? And so I think it's just very simply, we as an industry forgot how to do it. Because nothing is really, when we think about TRID, which is a 2013 rule, okay, it's been around forever. Nothing's really changed.
I mean, there's some revisions, clarifications,
Well,
clarifications.
Right. But as far as how you calculate some of this stuff on the loan estimate, I mean, it's really kind of been there. So I honestly, that's what I attribute it to. Now, we could have spent the entire time on this. So I want to keep this very high level, but the two biggest pieces of advice I can give on the proper disclosure of an arm loan. Page 1 of your loan estimate needs to show up to 4 payment streams in the projected payments section. And on an arm loan, you're required to disclose in each payment stream a maximum and a minimum payment, okay? How you calculate those is going to be based on worst case scenario pursuant to the terms of the loan agreement. So what I'm saying there is you have to take into account your caps, right? Okay. Each adjustment period, my rate can't increase more than 2%. Or over the life of the loan, I cap out at 12%, whatever the case may be, okay? Those are the factors that come into play for the projected payments. Now, flip over to page 3 of the loan estimate in the comparisons section and the APR. Well, everything I just said, throw it out the window because that's a completely different calculation. For calculating the APR, it's a blended APR based on number one, your introductory rate, if there is one, followed by a estimated rate for the remainder of the term that is based on the value of the index as of the date the interest rate was set, plus any applicable margin. Okay. Bottom line is two completely different calculations on the same document, but this is hugely important because think about what this implicates. You mess up these disclosures, you could find yourself in a position where you've understated APR and you got to write a check to fix that. You could find yourself in a position where your CD goes out incorrect, which means it's not material, which means that rescission stays open on those refinances until the disclosure's corrected. There's just a lot of downstream problems that can arise if you don't get the disclosures right the first time.
Now, okay. So LE is a big issue. So I'm guessing, in your time, you've seen some issues pop up on all those things you just mentioned, right? So
Absolutely.
but it's not just the LE that has to be disclosed with regards to arms, right? Are you seeing anything else with regards to the arm disclosure or the charms booklet's not going out or anything like that?
Yeah, so charm booklet, that's pretty straightforward. What I am seeing, you referenced the arm disclosure. I'm seeing a couple different things. Remember, for the application arm disclosure, you should have a separate variable rate disclosure for each type of arm product that you offer, and you need to provide for each type of arm product that I, as your member, express an interest in. The other thing to keep in mind, and this is more from a servicing standpoint, don't forget those subsequent disclosures for arms, right? Initial rate adjustment notice between 210 to 240 days before the first payment at the adjusted level is due. That's 7 months. That's a heck of a lead time, right? So yeah, to your point, Peter, I think what we have to reacquaint ourselves with are all of these arm requirements, because it's a product that's back in our arsenal of products that members are interested in.
Right. Yeah. And so it's the reason why it got on my list is because someone an organization reached out to me because, through different system updates, right? Because system updates, right?
Oh yeah.
Something became out of whack, right? If I remember correctly, it was the adjustments on the note did not match the adjustments on the LE or something like that. Anyways, they were seeking a list of proper calculations for each, or how to properly disclose each document. So that's why it was on my list. And so I appreciate you walking us through that. Because I'll be honest, does it make sense? Yes. It also, just like when we got out of 2020 and 2021, and all of a sudden we had to remember how to disclose a purchase. It's very similar to that, right?
Sure.
Here we are we were focused on fixed rates for so very long. And now arms aren't back to where they probably were pre-COVID from a demand level, because people still want that 30-year fix.
Yeah.
But it's still a popular loan, especially among credit unions. I personally love a 5.5 arm, right? I personally love, actually, my favorite one's a 15-15. That is like my dream loan, that if I could ever have, when I would lend it, if I was ever on the lending side again, a 15-15 arm would be my dream loan. So I get it. I understand. Thank you for walking us through that.
Yeah.
Now let's move on to the next. Anything else on arms real quick before we move on to probably my favorite topic of this conversation.
Yeah.
Well, it's not really my favorite. It's the one I have the most interest in.
Okay.
Fair lending.
I mean, fair lending, I
Well,
think
you might as well just throw your hands up in the air right now.
well, right. And here's the thing, and I think you mentioned this at the onset. Fair lending has been, is now, and will continue to be in the top 2 or 3 considerations for anybody doing any type of loan anywhere, right? It's just, this has got to be a constant focus for your institution. No way around it.
Okay. I mean, it's just talking to a few people at NCUA, right? I just get the feeling, right? And I've confirmed it with a few other friends in DC. I just get the feeling that it's gone. That fair lending where it seems like the NCUA is willing to work with us and guide us through better practices in fair lending. It just seems now all of a sudden it's now guilty until proven innocent, right?
So I think that's a great observation. And here's why I think it's that way. So this current CFPB administration has really tried to expand UDAP, right?
Oh yeah.
And the industry has pushed back and said, no, wait a minute. You can't call everything unfair, deceptive, or abusive. Okay. Well, be careful what you wish for, because now that's just going to make them focus that much more from a fair lending perspective. Call it whatever you want. Call it fair lending, call it unfair, call it deceptive. But if they see something they don't like, they're coming after you.
But UDAP's interesting though. There's what? UDAP is what came out, 2015 approximately?
Well, so it was, yeah, so it was Dodd-Frank that added, unfair and deceptive.
But it's always been, the industry, the mortgage industry as a whole has always kind of picked it apart. Same thing with the credit union side, right? There's always been the need for clarification. The CFPB has tried to clarify a few times, but they just added to the confusion time and time again, right?
Every single time. Yep.
But now there's going to be even more expansion, at least proposed expansion to UDAP, right? And yes, UDAP does fall underneath that fair lending. We can tie a lot back to fair lending.
Sure.
But again, with UDAP, it's okay. Well, you're saying I have a UDAP violation, but you're not providing clarification on what really constitutes that unfair or deceptive practice, right?
Yeah, I think you'll appreciate this. It goes back to that that Supreme Court case from a long time ago where I believe it had to do with, sorry, I know this is a family show, but I believe it was a case about pornography.
I think it's PG-13.
Okay, perfect.
You talk about it.
And the Supreme Court justice says, well, I can't define it for you, but I know it when I see it. That's what we're doing with UDAP. We're not defining it. We're not giving the industry guideposts within which to operate. We're just saying, we don't like it, so it's unfair. We don't like it, it's deceptive.
And for me, fair lending, it does tie into a lot of other topics, right? Fair lending as a blanket conversation ties into, yes, UDAP, right? It also ties into CRA, right? Because they're going to use fair lending against us and how the types of borrowers that we lend to from a different demographic standpoint or income standpoint against us. And when I say they, it could be federal regulators that happen to have a chip on their shoulder, or we'll say the bank side of our industry, right? They're going to use that against us to possibly push CRA on credit unions, correct?
Sure, 100%. CRA just went through I think the joint agencies just overhauled CRA. I want to say that was back in October, maybe.
Yeah. It was like the anniversary review, right, or something like that.
And I'll be honest, knock on wood, but I'm kind of shocked that as part of that, there wasn't a lot more push to bring credit unions within CRA. I think it's just a matter of time. That's
Well,
my opinion.
Well, it's they had other things to worry about, right? Other things to worry about that time.
Yep.
Now is a different time. So continuing on with fair lending, I want your opinion, and I'm gonna start off with appraisal bias, and Mandy hinted at it, right?
Yeah.
Now, appraisal bias is interesting, right? Because if we look back to last summer, right, with really we'll say this, the end of 2022 and we'll say the first half of 2023, appraisal bias and the PAVE task force, that was big conversation. It seems to me that we'll say, although we discussed our annual conference, right, things still started quieting down about appraisal bias, and we'll say July, August of last year, right? But it started to rear its head again.
Sure.
It started to come back up.
Yep.
What are your thoughts on it?
So there's a couple of things that I think we need to be prepared for when it comes to appraisal bias. A couple of proposed rules. Those of you that are doing, those of you that are using AVMs, automated valuation models, there was a rule that came out, proposed rule, I want to say June of last year, to implement quality control standards for automated valuation models. And a lot of this rule has to do with what kind of due diligence did the credit union do up front with your AVM vendor? Are you spot checking the reports that you're getting to make sure that you are comfortable with the valuations that are being returned? So this proposal is going to require you to put very specific policies and procedures in place to ensure those quality control standards. But that's the smaller of the two. The other thing that you have got to move to the top of your list, in my opinion, is this concept of reconsiderations of value. Okay. Very briefly, what is an ROV? Well, it's exactly how it sounds. It's a request of the appraiser to reconsider the value that he or she assigned to the subject property. Now, it's got to be based on the request to reassess has got to be based on something. Okay.
Mm-hmm.
Here's a comparable or two that we think that you should have looked at that you didn't. Here is unique property characteristics that were not adequately reflected in your report, whatever the case may be. But under this proposal, which I would imagine we're going to see go final sometime in the first 6 months of this year, you've got to establish policies and procedures for how your credit union is going to handle a reconsideration of value request, including make sure that your procedures are not so comprehensive that it has a chilling effect, right? You don't want to make it so difficult that you basically discourage members from asking. You have to identify who within the credit union is going to review these requests. And then you have to know, okay, if I take this reconsideration request to the appraiser and he or she says, that's my value, I'm sticking to it. Okay, what do we do now? Do we order another appraisal? If so, who's going to pay the cost? There's a lot of moving parts there. And I know maybe not so much NCUA yet, but very soon, they're starting to ask questions about reconsideration value already. What are your policies? What are your procedures? Right now, if your answer is we don't have them, okay, fair. 6 months from now, that answer is not going to work anymore.
But sorry to interject, but
yeah,
I could have missed it. It's tough keeping up with a lot of stuff. they haven't put out guidance specifically on what they want to see, nor has the CVB, have they?
Well, other than what was in the proposed rule,
Proposed
which
rule.
yeah, yep, proposed, has not gone final yet. So you're 100% correct. We don't know definitively what they want to see in those policies and procedures. But to your point, appraisal bias is kind of one of those things that just, it won't go away. And so I think we can look at the proposed rule, what their intent was, and we can start building out some of those policies and procedures now and hope for a little bit of additional guidance once the rule goes final.
Okay. But the
Yep.
moral of the story is have something in writing that
Yeah.
documents your process and procedures.
Yep.
Okay.
100%, 100%.
You know, we're kind of getting to that point where time is becoming a commodity.
Yeah.
But so I want to hit the next two topics rather quickly, if that's okay with you.
You bet.
Um,
That was, by the way, that's your nice way of saying, all right, we're done listening to you, Don Corleone. Let's move on.
by the way, I saw, you know, I like that reference. So, you know, I know
Yeah.
this has nothing to do with what we're talking about, but
Yeah.
I went back and watched The Offer on Paramount Plus. It was fantastic. And then I just
Yeah.
went back and watched every single Godfather movie for the first time. Amazing. Absolutely amazing. So I now understand that reference, which makes me very happy.
Yeah.
Anyways, well, someone did ask a question in the Q&A.
Yeah.
And they're pretty much saying, can you advise them on who issued the proposed rule?
Yes,
For
for both the AVM and the reconsideration of value, it was joint agency rulemaking.
the
So
PAVE task force?
I'm sorry.
Was it the PAVE task force or just kind of just put up?
No, it was the regulators, and NCUA was part of both. Yep.
Okay. All right.
And I don't know if my contact information, if you guys provide that, but if you can't find the proposed rule, shoot me an email. Happy to share it with you.
Any idea of when they issued it?
June of 23 was both of them, I believe.
All right, perfect. Thank you very much.
You bet.
All right, so real quick, I don't want to get the hook and pull you off stage, but let's quickly touch on AI. This
Yeah,
is,
okay.
you know, AI can be a really good thing, right? It can make our jobs more efficient.
Yep.
It can provide a better member experience as a whole, but that's not why it's such an important focus for fair lending, correct?
That is correct. Yeah.
Give me some your insight into that.
Yeah. So a couple very quick things on AI from a lending specific perspective. We're starting to see some guidance come out now that is referencing, okay, if you are a creditor and you are using artificial intelligence to decision loans, okay, to your point, Peter, it makes it more efficient, right? It can help us, but we've got to be careful. If we're using artificial intelligence to decision loans, when we get to our adverse action responsibilities, let's say I don't qualify because I don't meet your underwriting standards based on your automated underwriting. You have to still tell me exactly why I don't qualify, okay? You still have all of those consumer protection considerations. The other thing I'll say about AI is, I don't know how many of you are doing this, but TCPA, Telephone Consumer Protection Act, if any of you are doing marketing or advertising for your mortgage loans via text message, using AI to generate automated voice, all of those are going to be swept under the TCPA and the consent requirements. So it's
And that part just started, that part became a possible revision to TCPA, what, about a week ago, 2 weeks
Yeah.
ago, something like that?
I think
that's
it was
relatively recent.
Yep, I think it was last week. I think you're right, where the FCC put out that declaratory ruling, right? Yep.
Okay, so good. All right, so last one.
Yeah.
And best for last.
Okay.
You know, Section 8 specifically, let's focus on the digital mortgage comparison shopping platforms.
So if any of you are using digital mortgage comparison shopping platform, so basically you sign up, you pay a fee, your mortgage products are advertised on these platforms, okay? Be very careful. Some of these platforms will identify you as a preferred lender or skilled lender, and they're not really basing it on any objective criteria. They're basing it on the fact that you're paying them to be on their platform. That could get you into trouble from a Section 8 perspective, because now it starts looking like a referral, right? So be very careful about using those platforms, what you're paying for, how they're presenting your credit union on those platforms.
Very good. Very good. Well, Michael, we're pushing time, right?
Yeah.
Any final thoughts that you'd like to share with the group?
Just know, I mean, real estate, and I think you said this probably better than anybody at the very beginning. Our industry, the mortgage industry, this is just going to be a cost of doing business for us. We're always going to have this level of scrutiny. Just want you guys to know, you're obviously not alone. I mean, you guys, ACUMA, you guys put out so much good content. You have all of your events. You bring in these speakers to try and help lighten the load, so to speak. So you know what? We're all in this together. Hang in there. We'll get through it. Now, can we go back to Christopher Cross, please?
That would be great if we closed out with how we started. All right.
Yeah,
right.
yeah.
All right. Well,
hey, buddy, good to see you. Always good talking to you, my friend.
Michael, thank you for spending time with us. Really look forward to catching you at the next ACUMA event. Truly do.
Sounds good. Appreciate it. Thanks.
All right, thank you. Once again, thank you to Mandy Phillips and ACES Quality Management for sponsoring today's webinar. And again, to Michael Christian for his valuable insight. And really, I also have to thank all of you for attending today's webinar. Your time is valuable, and we appreciate you spending the better part of an hour with us today. We hope you enjoyed today's session. We appreciate that really 50 minutes, 55 minutes isn't nearly enough time to cover everything on this topic. So if you want to learn more and continue to fine-tune your knowledge, I'd recommend attending one of our upcoming events, where you'll find that we'll continue to expand upon all of these topics. Head over to www.acuma.org or our community page for more information and the latest updates on everything happening over here at ACUMA. Until next time, be well, my friends. Bye.